Welcome, everyone. Today, we are going to dive deep into understanding and setting up the volume indicator in RTrader Pro. This is one of the most powerful tools that can help you analyze the market better and make more informed trading decisions. If you want to get better at trading, understanding how to properly set up the volume indicator is key. By the time we are done, you will know the best ways to use the volume indicator to really get the most out of it and make it work for you. Imagine being able to read the pulse of the market, to see the strength behind price moves, and to understand whether those moves are built to last or just a fleeting moment. That is exactly what the volume indicator helps you do. Let us first talk about what the volume indicator actually is. The volume indicator shows how many shares or contracts are traded over a certain period of time. This helps us see if a price change is supported by real trading activity. When there is a lot of volume, it means that more traders are interested in that move. More interest makes the move stronger and more likely to continue. It is like when you see a crowd gathering somewhere, you think that something important must be happening. Volume works in a similar way. Higher volume means that the market is taking that price move seriously. Now let us expand on how volume can interact with different chart patterns to provide better trading insights. Chart patterns are visual representations of price movements that traders use to predict future price actions. These patterns, combined with volume, can tell us a lot about market sentiment and the likelihood of a trend continuing or reversing. Let us start with the head and shoulders pattern, which is known for signaling a reversal. When this pattern forms, volume plays a key role in confirming it. During the formation of the left shoulder, you may notice high volume as the price rises, indicating strong buyer interest. In the head formation, volume might be slightly lower but still significant, showing continued interest but perhaps some caution among traders. Finally, during the formation of the right shoulder, if the volume is declining, it can be a signal that the buyers are losing strength, making a reversal more likely. Volume confirmation is key here, as a reversal with low volume may lack conviction, making it more prone to failure. Another important chart pattern where volume is crucial is the double top or double bottom. In a double top, after the first peak, volume tends to drop during the pullback, and if the price makes a second peak with lower volume, it shows that the upward momentum is weakening. This is a strong signal that a reversal could be imminent. On the other hand, in a double bottom, you would want to see increasing volume as the price moves up from the second bottom. This suggests that buyers are stepping in with more conviction, supporting a potential trend reversal to the upside. Without the volume increase, the price might struggle to break higher, and the double bottom could fail. Triangles, including ascending, descending, and symmetrical triangles, are also popular chart patterns where volume analysis adds depth to your understanding. In an ascending triangle, you want to see volume increase as the price approaches the resistance level. This indicates that buyers are gaining strength and a breakout is likely. Conversely, if the volume decreases as the price approaches resistance, it may signal a weaker breakout or even a potential failure. In descending triangles, volume should ideally increase as the price nears the support level, suggesting that sellers are gaining strength and are likely to push the price lower. In symmetrical triangles, volume usually decreases as the pattern forms, indicating a period of indecision, but a spike in volume during the breakout confirms the direction of the move, providing the necessary conviction for traders to act. Flags and pennants are continuation patterns that also benefit greatly from volume analysis. During the formation of the flagpole, you typically see a sharp move with strong volume, which reflects strong momentum in the trend direction. This is followed by a period of consolidation where volume tends to decline, forming the flag or pennant. A breakout from the consolidation zone with increasing volume is a strong indicator that the original trend is resuming. If volume does not pick up during the breakout, the continuation may lack strength, leading to a higher risk of a failed move. Another interesting pattern is the cup and handle. In this pattern, the cup forms in a U shape, and ideally, you want to see volume decreasing during the formation of the cup, showing a lack of aggressive selling pressure as the price rounds out. When the handle forms, volume often dries up, indicating a period of consolidation and reduced activity. However, when the breakout occurs, you want to see a significant increase in volume. This confirms that buyers are stepping in, making the breakout more likely to succeed. A breakout without a volume increase may signal a lack of commitment, which could result in a false breakout. Wedges, both rising and falling, are additional chart patterns where volume is crucial for analysis. In a rising wedge, volume tends to decrease as the price moves higher and the range narrows, indicating a weakening trend that may lead to a bearish reversal. For falling wedges, the opposite is true. Volume generally decreases as the price moves lower, and a bullish breakout with a volume spike often confirms that the downtrend is coming to an end. Another important pattern to consider is the rectangle. This pattern forms when price moves between two horizontal levels of support and resistance, creating a consolidation zone. Volume tends to decrease during the consolidation phase, and a breakout, whether up or down, should be accompanied by a significant increase in volume to confirm the move. Without volume confirmation, the breakout may lack the momentum needed to sustain the movement, leading to a potential return to the consolidation range. By understanding these chart patterns and incorporating volume analysis, you can significantly improve your ability to predict future price movements. Volume helps confirm whether these patterns are forming with real market participation or if they lack strength, which helps in avoiding false signals. Remember, patterns are most powerful when volume supports them, so always keep an eye on how volume behaves at critical points in these formations. Combining these insights with your trading strategy can provide a strong edge in anticipating market moves. Another chart pattern where volume is crucial is the double top or double bottom. In a double top, after the first peak, volume tends to drop during the pullback, and if the price makes a second peak with lower volume, it shows that the upward momentum is weakening. This is a strong signal that a reversal could be imminent. Conversely, in a double bottom, you would want to see increasing volume as the price moves up from the second bottom. This suggests that buyers are stepping in with more conviction, supporting a potential trend reversal to the upside. Triangles like ascending, descending, and symmetrical triangles are also popular chart patterns where volume analysis adds depth to your understanding. In an ascending triangle, you want to see volume increase as the price approaches the resistance level. This indicates that buyers are gaining strength and that a breakout is likely. On the other hand, in a descending triangle, volume should increase as the price nears the support level, suggesting that sellers are likely to push the price lower. In symmetrical triangles, volume usually decreases as the pattern forms, but a spike in volume during the breakout confirms the direction of the move. Flags and pennants are continuation patterns that also benefit greatly from volume analysis. When the flagpole forms, you typically see a sharp move with strong volume, followed by a period of consolidation where volume declines. A breakout from the consolidation zone with increasing volume is a strong indicator that the original trend is resuming. Another interesting pattern is the cup and handle. In this pattern, the cup forms in a U shape, and ideally, you want to see volume decreasing during the formation of the cup. When the handle forms, volume often dries up, but when the breakout occurs, you want to see a significant increase in volume. This confirms that buyers are stepping in, making the breakout more likely to succeed. By understanding these chart patterns and incorporating volume analysis, you can significantly improve your ability to predict future price movements. Volume helps confirm whether these patterns are forming with real market participation or if they lack strength, which helps in avoiding false signals. Remember, patterns are most powerful when volume supports them, so always keep an eye on how volume behaves at critical points in these formations. To start with, let us look at how we access the volume indicator in RTrader Pro. It is quite simple. First, you need to head over to the indicator menu. You will find a list of indicators, and we want to find the one called volume. Once you find it, click to add it to your chart. When you do that, you will see bars appear at the bottom of your screen. These bars represent the volume of trades over the chosen time period. To make the indicator easier to read, you can set it up with different colors. For example, you could use green bars to represent buying activity and red bars to represent selling activity. This way, at just a glance, you will be able to tell whether buyers or sellers are in control. Time frames are very important when it comes to using the volume indicator. Let us talk about how to choose the right one for your trading style. If you are someone who likes to trade within the day, then you want to use shorter time frames. These could be charts that show 1 minute, 5 minutes, or even 15 minutes at a time. This helps you see quick moves, volume spikes, and how they align with rapid price changes during the trading session. When trading with shorter time frames, you can identify breakout opportunities or sudden reversals that might not be visible on a longer-term chart. For example, a sharp increase in volume on a 1-minute chart could signal the start of a strong breakout move, which can help you enter or exit trades faster. Additionally, you might encounter patterns such as bullish or bearish flags within shorter time frames, where volume confirmation is key to validating the potential continuation of the trend. A spike in volume when price breaks out of the flag pattern often indicates a strong continuation. Moreover, you should watch for triangles and pennants on these shorter time frames. Bullish and bearish pennants are particularly helpful in day trading, as they signal a consolidation followed by a strong continuation in the direction of the previous trend. In these cases, volume should spike on the breakout for the signal to be considered valid. Symmetrical triangles are also common in shorter time frames. When the price action converges within a narrowing range, a volume spike on breakout is necessary to confirm the move. Without volume, the breakout might fail or result in a false signal. Another key pattern to look for is the intraday double top or double bottom. These patterns tend to form quickly and can give strong reversal signals if supported by volume. For a double top, watch for declining volume on the second peak, which suggests that buying interest is fading, indicating a possible reversal. For a double bottom, increasing volume on the second dip often means that buyers are stepping back in with strength, supporting a reversal to the upside. Understanding these volume dynamics can give you an edge in entering or exiting trades at the right time, maximizing your gains or minimizing losses. On the other hand, if you are a swing trader who likes to hold trades over a longer period, hourly, 4-hour, or even daily charts would be better. This will help you see the bigger picture, spot the major trends, and understand how volume plays out over time. Volume patterns such as accumulation or distribution become clearer on longer time frames. Accumulation happens when there is consistent buying interest over a period, usually at a support level, often signaled by increasing volume during price consolidations. Distribution, on the other hand, occurs when sellers dominate, often at resistance levels, with increasing volume as price attempts to break through but fails. Triangles also play a role on these longer-term charts. For example, ascending triangles often form over several days or weeks, and the volume analysis can show us whether there is enough strength for a breakout. When price moves up towards resistance with increasing volume, it is a sign of potential strength. A descending triangle, however, often shows weakening buying interest, especially if the volume spikes during downward price movements. Symmetrical triangles show indecision but eventually break out, and the volume pattern during the breakout provides crucial information about the strength of the new move. Picking the right time frame is important because it helps you match your volume analysis with your strategy, making your signals more accurate. For swing traders, the ability to see volume trends over multiple days or weeks is crucial for making informed decisions and avoiding false signals. It allows you to identify major support and resistance levels and understand how volume behaves as price approaches these levels, which is key in predicting whether the level will hold or break. Now let us move on to settings for the volume indicator. RTrader Pro gives you some default settings, which are a good place to start. You will notice that green is used for buying volume and red is used for selling. But do not feel like you need to stick with the default settings. You can make changes that help you better see what is happening in the market. You could make the volume bars a bit thicker if you want to make volume surges stand out more. You could also make the bars more transparent so they do not distract from other things on your chart. One thing that can really help is adding a moving average to your volume indicator. The moving average smooths out the volume, making it easier to see trends over time. Let us talk a bit more about adding a moving average to the volume indicator. This can be very useful for getting a sense of whether the current volume is above or below normal. If the volume is higher than average, it might mean that something big is happening. A good choice for a short-term moving average is using a 20-period moving average. For longer-term traders, a 50-period moving average might work better. To add this, you just need to go to the indicator settings, pick Add Moving Average, and choose the period that fits your trading style best. Another great thing you can do with the volume indicator is to combine it with the volume weighted average price. The volume weighted average price shows the average price but takes into account how much volume has happened at each price level. If the price is above the volume weighted average price and volume is also going up, this often means that the price move is strong and likely to continue. But if the price is below the volume weighted average price and there is a lot of volume, that is usually a sign that there is a lot of selling pressure. One mistake that some traders make is relying too much on the default settings. It is a good idea to explore and make adjustments that better suit your specific needs. Another common mistake is using the wrong time frame. Always make sure that your volume settings match the time frame of the chart you are looking at. Finally, remember that the volume indicator is just one tool. It works best when used alongside other tools like moving averages or the relative strength index. The more information you have, the better your trading decisions will be. One thing you can do to improve your volume analysis is to adjust the sensitivity of the volume indicator based on the market conditions. If the market is very volatile, you could shorten the moving average period. This way, it will highlight any big volume spikes and help you quickly identify significant movements. In these situations, identifying volume spikes can also help you recognize potential breakouts or reversals earlier. If the market is quiet, you might want to use a longer moving average period to smooth out the noise and get a clearer picture of the overall trend. A longer moving average helps filter out minor fluctuations that may not be important, allowing you to focus on the key volume trends that drive major price movements. Additionally, consider adjusting the volume thresholds to better reflect current market conditions, lowering thresholds in quieter markets to capture more subtle changes, and raising them in volatile periods to avoid false signals. This will help you avoid reacting to small, unimportant changes and instead focus on more meaningful volume signals. Expanding on chart patterns, let us also consider the significance of volume in some lesser-known but highly effective patterns. One such pattern is the rising and falling wedge. The rising wedge is characterized by a narrowing range with higher highs and higher lows, typically signaling a bearish reversal. Volume often decreases as the wedge forms, showing diminishing buying interest. When the price breaks below the lower trend line, an increase in volume confirms the reversal. Conversely, in a falling wedge, volume typically decreases during the formation as sellers lose strength. A breakout to the upside with an accompanying volume spike often indicates a bullish reversal. Another pattern to watch for is the broadening formation, sometimes called a megaphone pattern. This pattern shows increasing price swings with no clear trend, forming higher highs and lower lows. Volume analysis in broadening formations is crucial because a breakout in either direction with a significant volume increase often signals the end of the indecision and the start of a strong new trend. If volume is low during the breakout, the move may lack conviction and could result in a false signal. Volume is also crucial in identifying false breakouts in many chart patterns. For instance, when a breakout occurs from a consolidation pattern like a rectangle or a triangle, but volume does not increase, it is often a sign that the breakout lacks the necessary market support to continue. Traders who understand these volume dynamics can better determine whether to commit to a trade or wait for stronger confirmation. Volume climax is another important concept to understand in relation to patterns like double tops, double bottoms, and reversal candlestick patterns. A volume climax occurs when there is a sudden and dramatic increase in volume, often marking the exhaustion of the current trend. For instance, a double top with a volume climax on the second peak suggests that buyers have hit a wall, increasing the likelihood of a reversal. Similarly, a volume climax during a bullish engulfing candlestick at the bottom of a downtrend may signal the end of selling pressure and the start of a potential reversal. By thoroughly understanding these additional patterns and the role of volume within them, you can expand your ability to predict market movements and make better trading decisions. Proper volume analysis can reveal whether a price movement is supported by significant participation, helping you to discern between reliable signals and those that are likely to fail. A great way to use the volume indicator is to combine it with price action. For example, volume often spikes when the price reaches key support or resistance levels. If the price is at one of these levels, the volume indicator can tell you if a break or a hold is backed by strong market participation. Another thing to look out for is volume divergence. This happens when the price is moving in one direction, but volume is declining. It can mean that the trend is losing strength and that a reversal might be on the way. When fine-tuning your volume settings, think about your trading style. If you are an intraday trader, you want to be quick to catch sudden changes, so use shorter time frames and make the volume sensitivity higher. This helps you catch those quick volume spikes that signal breakouts or breakdowns. You will also want to pay close attention to chart patterns like bullish or bearish flags, triangles, and pennants, which can all form on shorter time frames. Volume is crucial for confirming these patterns. For example, in a bullish flag, you want to see high volume during the initial sharp move and lower volume during the consolidation phase. A breakout from the flag with a spike in volume is a strong continuation signal. If you are a swing trader, you are more interested in the bigger picture, so you might want to focus on higher time frames and use a longer moving average. This way, you can avoid getting caught up in short-term noise and focus on the major trends. You should also look for chart patterns like head and shoulders, double tops or bottoms, and cup and handle patterns, as these tend to form over longer periods and require more time for confirmation. For instance, a double bottom with increasing volume on the second bottom can signal a strong reversal. Understanding how volume behaves around these chart patterns will help you decide whether the trend is gaining or losing strength, allowing you to make more informed trading decisions. Let us recap what we have talked about today. The volume indicator in RTrader Pro is a key tool for understanding what is really going on in the market. Whether you use it alone or combine it with other indicators like the volume-weighted average price, moving averages, or price action, it helps you confirm trends and identify breakouts or reversals. Start by exploring the default volume settings and adjust them to fit your trading style. Do not forget to add a moving average to help you see trends more clearly. And always use volume alongside other tools for more reliable signals. Learning to master the volume indicator in RTrader Pro takes time and practice. But with the right settings, you can gain a much deeper understanding of market dynamics and make better trading decisions. Keep practicing, keep adjusting, and you will start to see just how much value this tool can add to your strategy. Remember, the market is always changing, so it is important to stay flexible and open to learning new things. What are some ways you use the volume indicator in your trading? Feel free to think about how these settings could work for you. Try out some of the ideas we talked about today and see what works best for you.